Hi, Daria.
Hi.
Hey, all right. We're in the right meeting, huh? Let me just get a little bit organized here, okay? Gonna dig out my file here. I just got done teaching another class. Still with me, Daria? Okay. Come on, come on, come on, come on. Oh, I think we got it. Okay, we went through chapter 4 the other day, correct? Do you have any questions in this chapter? You feel pretty good here? Ready to go on to chapter 5? Okay, give me a moment. Can you see that worksheet, adjusting entries?
Yes, I can see chapter 4.
Chapter 4, okay, I just have to share chapter 5 here. There we go. Oop, nope, hold on. How about now? Chapter 5, okay. All right, I'm just gonna set it up my way. It might be just me and you today, huh? The two Russians. I guess I'm half Russian. My father spoke nothing but Russian to my grandparents, and I never learned any of it. It's much to my regret. All right, here we go. Adjusting journal entries. Every journal entry that we've recorded up to this chapter, Daria, has been with external people. In other words, we've bought things from somebody outside the company. We sold things to customers. We paid our employees. We paid the electric company. Everything we've done so far are called external entries, normal business transactions. At the end of the month, we have to do what are called adjusting general journal entries. And this is where we're going to go. At the end of the month, we're going to run that trial balance, right? We're going to run the trial balance and we're going to say that our debits equal credits. But by definition, that trial balance is incomplete because it does not have certain information that can only be journalized at the end of the month. For example, we have equipment wearing out. That is depreciation expense. And we've seen depreciation expense, right? A debit to depreciation expense and a credit to accumulated depreciation. We have these prepaid accounts, prepaid insurance. We bought an insurance policy in December that covers the following year. So when we bought that policy in December, We don't have any insurance yet. That policy doesn't start till January 1st. So we put it into an account called prepaid insurance, which is an asset account. And during the following year, every month, we have to reduce the use of that asset by recording it as an expense. Employees earning wages that have not been paid yet. You work for me, say, and you work the last week of the month and you earn $1,000. You worked from December 24th to the end of the month, say. You're not going to get paid for 2 more weeks. That's the company policy. But you worked those hours in December. We have to record that expense in December. That's another example of an adjusting journal entry, which will go in some detail. So we're talking about the adjusting journal entries to honor the matching principle. Matching revenues and expenses. That's what the matching principle is. Revenues should be recognized when earned, has nothing to do with whether we not got cash. Same thing with when they're earned if it was a service, okay? Expenses, recognized when incurred, when experienced, when they took place, regardless of when cash is paid. At the end of the month, Daria, we're looking at our trial balance and we see a big fat 0 next to the electric expense. Well, we know we used electricity during the month, but we're not going to get that bill probably for another 25 days. We don't wait until we get the electric bill. We must estimate a number now to the best of our ability. And that is another example of an adjusting journal entry. Adjusting journal entries. Matching principle, again, revenues and expenses. To follow that principle, accounts must be brought up to date. Any prepaid account needs to be reduced by the amount of the benefit we got, any depreciation expense, and any expenses that we incurred but not paid yet or recorded. Fiscal year, we know what a fiscal year is, 12 months. Does not have to be a calendar year. And many businesses schedule their fiscal year when things are slow. Good example of that is Nordstrom's, Macy's, the big department stores. I've learned that they close like at the end of February. Their year goes from March 1st to the end of February when things are a little bit slower. One of the stocks I own is makes cereal, breakfast cereal, and their fiscal year goes from like May to April, starts with the planting season and ends with the harvest, follows the business cycle rather than the calendar. So here we go. Let's start by looking at what we're talking about here. Adjustment for supplies. During June, Mitch purchased $80 of supplies, right? And we debited supplies. This is an asset account. I wish it said prepaid supplies, but in our class, supplies is an asset. Supplies expense is the expense. So Mitch has this asset here worth $80. But at the end of the month, he went out and counted how much he had left. There's only $20 left of these $80. So he used $60 worth of supplies. That $60 is going to be our supplies expense. We're going to debit supplies expense and credit the prepaid supplies. Okay? Does that make a little bit of sense what we're trying to do? We'll get into a better example with the insurance, I hope, in a moment. So you can read the numbers, right? I can barely read them. Here we go. Supplies were $80 at the beginning. We used 60, and we knew that because we counted the 20 at month end. So our journal entry is a debit to supplies expense and a credit to the supplies account. And you can see why this is an internal entry. Internal. We're the only ones who know about this. We're not dealing with a customer or a vendor. This is just internal things we need to do to the matching principle. Now, prepaid insurance. This is always a good one. During June, Mitch paid for a 10-month policy. The policy begins on June 1st. The policy begins on June 1st. Well, that looks to me like it's $70 a month. Would you agree? Now, June is ended. We have to recognize the month ended, and we did have insurance expense that month, and that insurance expense is 70, and thus the asset has been used up to the same exact number. Here we go. Prepaid insurance was 700 minus 70. We're down to a balance of 630. There's the debit to insurance expense. What we're going to do, Daria, we're going to do the same thing in July, August, September. We're going to write the same exact entry. And after those 10 months, the balance in this account will be zero because the policy has expired. And we're going to see $70 worth of expense every month for the next 10 months. Debit, insurance expense, credit, prepaid. Adjusting journal entries, Daria, for the most part, are a search for unrecorded expenses. It's pretty much what we're talking about. And a couple of revenues, but mostly we're looking for expenses that have not been recorded. Okay. Here's the most common one, Accruals. Accrual, ACC or UAL. An accrued payable is a temporary payable. An accrual is a liability, a short-term liability, current liability. Unpaid wages. Rohan paid his part-time employees $16.50 on June 27. Okay, that's the expense, and it's been recorded through June 27. But from the 28th through the 30th, his workers earned another $400, but they haven't been paid yet. They're not going to get paid until maybe next week or maybe 2 weeks if they get paid, every 2 weeks. That $400 needs to be added to the $16.50, and that should, you can have your choice, Daria. This number's wrong or this one. They should be the same, okay? I don't like to change these because these are from my boss. Okay, so what is our journal entry? Well, that's $400 worth of expense. We can call it wages expense or salaries expense, and we're going to credit accrued wages payable. It really should have the word accrued in front of it, but that's okay. Debit wage expense. So let's see what happened. Remember, they had already recorded the payroll through the 27th. That was already there. Now we are debiting $400 that our people earned for the last 3 days of the month, and we're going to credit wages payable. And this is important because it matches revenues and expenses. But another way to look at it, Daria, this liability here, the company has to pay you that on June 30th. If they fired you, for example, if the company went out of business, they owe you the money on that date. If you quit, they have to pay you on the 30th. The only reason they're not paying you for another week or two is because when you were hired, they explained that was the policy. And of course, you said, you were okay with that. So take a look at this. Our wages expense is now correct. It covers the entire month from the 1st to the 30th. And of this amount, we owe $400 in the form of a liability. Any questions on that? Not too tough so far, huh? Adjusting journal entries can be tricky when you start doing them, believe me. The historical cost principle, huh? Everything on our balance sheet is at the actual cost. And that cost is going to remain on the books forever, unless you sell it. You do not adjust for changes in the market value of the asset. And my favorite example is you bought land in Santa Barbara 30 years ago for $100,000. You debited land and you credited, cash. 20 years later, whatever, that land is now worth $1 million. It's still still 100,000. Historical cost principle. You can never increase it. When you purchase a fixed asset, like a car, a machine, a building, a big piece of equipment of some kind, that asset is going to help you sell your product. That asset is going to be used to pour the soda into the can and seal up the can, whatever product you're making. We're going to come up with what's called the useful life of that asset. Companies have quite a bit of flexibility. They can kind of determine what they think a reasonable, useful life is for this machine. And they can do this, machine wears down. It no longer does what it should as efficiently. So we're going to take this asset and we're going to expense it out over the life of the asset by recording depreciation expense. Let me ask this question. Is this the first time you're seeing depreciation expense? Have we done this at all yet? First time. Okay. Depreciation expense. It means to depreciate means the value is going down, theoretically. So companies are allowed to expense that asset over a period of time by debiting this expense called depreciation. And in our course, until we get to the next chapter or so, we're going to work with what's called straight line depreciation. Depreciation expense is an estimate. It has nothing to do with what the machine might actually be worth. It's just an accounting convention that businesses can use. Businesses love this journal entry because it is an expense that lowers its income, but it doesn't do anything with cash. So it's a tax savings. Salvage value. That asset that we're going to depreciate in a moment might have a salvage value or a scrap value or a residual value. They all mean the same thing. What it means is we bought a big truck for $100,000, and we said that truck is going to last us 10 years. We also think at the end of those 10 years, that truck is going to be beaten to death and probably not worth too much. But we think a scrap dealer will take it off our hands for $1,000. That is scrap value. That is the residual value. And what you're going to see in a moment, Dory, is you don't depreciate that portion of the asset. Straight line. It means we're going to just have the same amount of depreciation every month, every year. So here's the calculation. Mitch has motor scooters, and he thinks they're going to last 5 years or 60 months. The salvage value is 0, which makes it easier. We don't have to worry about it. Assume that a full month's depreciation is recognized every month, right? The depreciable cost is thus spread over 60 months. We're going to take $4,800 and divide it by the life of the asset. So every month, we are going to depreciate this thing $80. We're going to say, this is our depreciation expense. Here is the journal entry. Well, not yet. The journal entry is going to be a debit to the expense and a credit to an account called accumulated depreciation. We'll show you that in a second. The book value of an asset. Remember I said that you never change the cost of the original asset. It's always going to be, say, $1 million. But we are depreciating it every month. So every month we're going to debit an account called depreciation expense, and we're going to credit this account. It's called accumulated depreciation. It is a contra account, meaning it has the opposite sign control, a contra. Accumulated depreciation is contra to the original cost. So we never credit the original cost. What we credit is the contra account, and what we're reducing is the net book value. Net book value, original cost minus the accumulated. Has nothing to do with market value or what the item is really worth. I can't wait till we get to this journal entry, huh, Dari? We got like 5 pages here. Accumulated depreciation. Contra means the opposite. This is an asset with a normal credit balance. It goes up with a credit balance. And then you deduct it from the related asset to get the net book value. So here is your journal entry. Debit depreciation expense, credit this contra asset, accumulated depreciation dash whatever the asset is. So this part, pretty easy. You debit that expense, depreciation expense. Now, please take a look over here. We credited $80 here, right? We did not credit this $4,800. That $4,800 is there forever, untouched. What we're going to credit is the contra. So after this first month, $4,800 minus 80 equals 4,720. That's called the net book value, okay? And here they're just showing you some of the new accounts we're going to be working with here. This is the first time you're seeing accumulated depreciation and depreciation expense and a few other things. Wages payable, our chart of accounts. Notice assets begin with 1, liabilities with 2, 3 for equity, 4 for revenues, and 5 here. That's typical. That's what I've always seen. I don't think I've ever seen different. But that's interesting, isn't it? They put a point here, 1, if it's a contra, just to help the world know that it's a contra account. All contra accounts are married. All contra accounts are in a significant relationship with another account. So accumulated depreciation is married to the fixed asset. Here, they're going to show us the postings that we just looked at in color, but let's take a peek at them. Supplies expense. We debited the expense, and the balance is now 60. This is our general ledger. This is not the journal entry. This is the general ledger. So we had nothing to begin with. We now put the $60 into the expense, and the balance is now $60. And they use the word adjusting to identify the transaction. In the future, 6 months from now or a year from now, the auditors ask you what this journal entry is. If you don't see this adjusting thing, you're not going to remember off the top of your head. And they're just taking it a little step further here. Hey, how do you like that? I'm zooming. Here is a journal entry. Debit supplies expense, credit supplies. Here's your general ledger. Here's what we were just looking at, 60. Good grief, here it is here. You had 80 to begin with, 60, and the balance is now 20. This is the journal entry. This is your general ledger, okay? Supplies expense. Here it is here. Debit 60, credit, debit expenses there, okay? This is the prepaid account. That's not supplies expense. That's the prepaid supplies. It was 80. Now it's down to 20. This went from 0 to 60. And they're just showing you the other accounts. Let's look at the prepaid insurance. We paid for this insurance policy on, they don't tell you the month, but then we don't care. Oh, June 1st, they told us, huh? We paid $700 for this policy. Here's your general ledger. We bought this policy on June 18, And the policy is effective June 1st. So it's $70 a month in expense and a $70 use of the asset. This asset at the end of June is $630. At the end of the next period, it'll be $560, etc., until we get to zero. Here, every month, you're going to see the $70. And they're just finishing it up here with the other entries. Wages payable, money that you earned working for me. And because you earned it in the last few days of the month, I have to put that expense in the proper month. That belongs there. And it also means that I owe you $400 at that point. It's a legal obligation at that point. I owe you the money. Depreciation expense, here we go. What makes depreciation expense easy, it's always the same two accounts. It's always a debit to depreciation expense and a credit to accumulated depreciation. No exception. It's not like here where you might have to accrue wages, you could have a telephone expense, rent, there could be hundreds of things. Here, it's just depreciation expense and accumulated depreciation. I tell students, you pray that the depreciation expense is on the test because that's the one without any exceptions. Now, the month is ended, right? We printed our trial balance. We looked at it and we adjusted it as we deemed necessary. Now we're ready to get going on the financial statements. But first, we have to update the trial balance. So we're going to prepare a 10-column worksheet, 10 columns. We're going to we're going to enter the adjusting entries, prepare the financial statements. This is just a worksheet. It's just a piece of paper that we're going to work with. 10 columns. Wow, 10 columns. What are we talking about? The first 2 columns is the trial balance. Trial balance. The next 2 columns will be the adjusting journal entries. The next columns, the next 2, will be the corrected journal entry, the adjusted journal entry. In other words, the trial balance plus or minus the adjustments equal this. And now that we've adjusted it, the next 2 columns are going to be for the income statement and the balance sheet. The worksheet tells you to put the name of the company on it, okay? This is the same trial balance from chapter 3. Now we're showing it on the worksheet. Step 1, we know this already, huh? Prepare the trial balance. Prepare the trial balance. Second step, which is what this whole chapter is about, Daria, prepare the adjusting journal entries. Adjusting journal entries. Make sure each adjustment is on the right line. I think we know that. And use some kind of a letter to link them up, and you'll see that in a moment. And make sure the adjustments equal. I'm so happy I found Zoom. Zoom. Here is our worksheet. Look at the size of this thing, huh? Woo. Let's divide and conquer. This is what we already did in chapter 4, remember? We prepared the trial balance and we went ahead and used these numbers to prepare the financial statement. So we said this guy had income of 8 minus these expenses. It turns out that wasn't quite right, huh? Because we never thought about the adjusting entries. So let's take a peek at the next 2 columns. Well, let's start with A. Let's start working with our debits first. A, we debited the $60 worth of supplies, right? Debit supplies expense, credit supplies. B, We had that 10-month, $700 insurance policy. We debit insurance expense for 70, and we reduce the prepaid insurance by 70. C, remember you did all that work the last 3 days of the month? Debit to wages expense, credit to accrued wages payable. Depreciation expense, the easy one. You debit $80 here and you credit accumulated depreciation. You never touch that line, right? Not too bad with that. You understand how important using these letters are, obviously, I hope, huh? Okay, now we're ready to do the adjusted trial balance. And basically, we're just going to add the first two columns to the second two columns. Debiting and crediting is necessary. So let's see if they show us. Look at that, huh? That's beautiful. Let's see what we did here. Cash. We had $470 in the bank. Do you think you will ever write an adjusting entry for cash? No, you don't do that. You know, your boss is not going to say, Daria, go to the safe and count the cash. And you come back, boss, there's only $200 there. Oh, okay, we must have spent it. No. Same thing with accounts receivable. You would never adjust that. Supplies. We know we use supplies. We had 80 at the beginning. We used 60. How much do we have left? Prepaid insurance, 700. We used 70. We got 630 left. You get the idea? Accumulated depreciation. We had none to begin with. Now we have 80. And so on and so forth. Wages payable. We didn't have any. Now we do. Wages expense was $1,650. We add your last 3 days of work. It's up to here. 0 supplies expense, 0 insurance expense, 0 depreciation until we adjust it. Do you feel comfortable what we're doing to get these last 2 columns here? Not too tough. Not too tough. Let's see what it says here. Yeah, if no adjustment, you just bring it over. And if it's a debit or credit, you work with it, huh? Now that we have that pair of columns done, we can now prepare the the financial statements. Okay. So the next 2 columns are going to be the income statement, and then the next 2 will be the balance sheet. And here's how we do it using the worksheet. Holy cow, look at all these instructions. Complete the worksheet. You fill out the columns, calculate the difference. I'm going to show you rather than talk through all this, okay? Here is your completed worksheet. Okay? So let's take a look. Here's what we've done so far. Here is our final adjusted trial balance. Remember what I told you guys? Go to your first revenue account, put a horizontal line there. Everything from that point down is your income statement. Everything above it is the balance sheet. How easy is that, if you remember that? So here is our income statement right here. Income statement. The revenue was $8,000 minus gives us a number. That total is $3,360. So 8,000 minus 3,360 is our profit of 4,640. Now we just need to balance this out so it equals. So we're going to go to the lower number and increase it to get it up to 8,000. If we've done this correctly, now we brought over all the balance sheet items from that side. If we've done everything correctly, we're going to have a difference in the same amount, this time on the credit side. Okay? We're adding it. All we have to do now is prepare the financial statements on paper. Our income statement, we are just going to copy all these numbers over and turn it into an income statement. And we're going to do the same thing with the balance sheet, except for one number. What number is going to change? The capital, right? The capital is going to change. That 5,000 is going to go up by the net income minus any drawing. Let's take a look. They're talking about finding errors. They tell you things like double check. I think we know these types of things, but you can read that for yourself. I'm just going to mention one. Have you ever heard of a transposition error? Do you have a calculator in front of you? Do me a favor, could you listen here? Put in 252 minus 225. That's 27, right? You meant to put in 252, but you accidentally put in 225. Anytime you reverse a number like that, the difference is divisible by 9. Now, why am I telling you this? In the old days, when it was done in pencil, you were always going out of bounds, you know, it wasn't with computers, but it's still a useful thing to know. Okay, it's just a good thing to know. And even when you're working in Excel or with QuickBooks or whatever thing, if you make that kind of mistake, that little tip might help you. That's all. Transposition errors. Now we write the journal entries, huh? Journalize the adjusting entries, the worksheet. Here we go. This came right off of the worksheet. Zoom. Here's our worksheet. And they're helpfully giving us colors, whatever. But here's our income statement, like we said. Here's the adjustments. And what they're doing on this page here, Daria, is showing us the journal entries. When you put it into the worksheet, obviously you still have to put it into the general ledger, right? That's all they're saying. There's the journal entries. They come right from the worksheet. Right from the worksheet. Explain the cash, modified cash. I ain't going to do that. We're not going to do that. We're not going to even talk about it. We only talk accrual accounting at our school because that is what the entire world uses. If you use a cash, what they call cash basis, you're going to cash basis yourself out of business in no time because it's not a proper way to do things. Cash basis is for a small, tiny business where they know what they're doing, there's no fluctuations. We're accrual basis. Accrual basis means we record expenses when they occur. Cash basis, they record the expense when you pay it, which is no good, not GAAP, no good. So here we go. Here's what we do. We record them when revenues, expenses, when earned, and that's the way we match the matching principle. It's the best method, best matching of revenues and expenses, accrual basis. If you're ever working with somebody or talking to somebody and they say, I run my business on a cash basis, I have a feeling they really don't, but they think they do. They're probably following the right rules. He probably means we have cash. Cash basis. Not going to go over this. Don't want to see it. Get away, get away. Okay. Depreciation. Let's go over the calculation for straight line depreciation. You're going to be taking accounting 230, right, Daria? When you do, you'll learn more than one depreciation expense. Here, I think we're just going to work with the most popular one, straight line. In this example, we bought a van for $40,000, 5-year useful life. Here it had salvage value. We think after 5 years, when we beat this thing to death, this is a van. This thing is going to be driven 24/7, delivering our products all over the state. We're going to put a lot of miles and wear and tear. At the end of 5 years, we're going to buy a new one, but we think somebody will give us $4,000, take it off our hands. We do not depreciate the $4,000. So this is very important. Under this method, an equal amount of depreciation each period. Cost less salvage value is the depreciable amount, the depreciable cost. So we're going to take 36,000 divided by 5 years or 60 months to get our number. And here it is. The depreciable cost is not the 40,000 we paid, but the 36,000 after we remove the residual value, the scrap value. So our depreciation expense every month is going to be a debit to depreciation expense for 600, credit accumulated depreciation. Feel pretty comfortable with the straight line? It's really not. It's the easy one. Straight line. Straight line. You can also think of it in terms of a percentage, right? If it's 5 years, it's 20% a year. Straight line. Here is, I think this is kind of nice to look at for a moment. Here, we started off with a depreciable expense of 36,000. Here is our journal entry. Our journal entry. Debit depreciation expense, credit accumulated depreciation. That's going to be the same every month. Every month, we debit depreciation expense, and the accumulated depreciation grows by 7,200 until it equals 36,000. And here, our depreciable amount of 36 is going to stop at 4,000. You never go below the salvage value. Just a rule that you're going to be learning. We're not doing sum of the year's digits. Okay, I'm going to stop us with straight line because I don't think we go any further in this class. I'll talk to Cornelia about that just to triple check. Okay, but you're going to get these other methods when you get into 230. Wow, modified cost. So that's pretty much it. What do you think, Daria? What thoughts do you have here?
I think that's fine. Like, I need time to think about it, like, to
Of
write.
course.
Yeah, but
Yeah.
everything is okay. Like, understand everything.
Okay. Yeah, that should, I don't think this is too tough, but what's confusing is the concept. Why are we writing these journal entries? Well, because we have to recognize certain expenses cannot be recorded until the end of the month. Like depreciation expense. You could theoretically do depreciation expense every time you buy an asset. But why would you do that? You wait to the end of the month and do them all at one time, right? Okay. Well, that's pretty much the Bob Smagula tour of chapter 5, okay? So what do you think? Call it a meeting?
Yeah.
Someone's eager to go, I can tell. Oh, you want to hear some joke? No, we're done. Hey, you take care, Dara. I'm so glad you showed up. I would have been twiddling my thumbs by myself. Okay, you take care, okay? Bye-bye.